trading securities and available for sale securities, short-term investments. What happens at the end of the year that makes it so important to understand the difference between these two? And it has to do with where the unrealized holding gains and losses show up. For trading securities, unrealized holding gains and losses that result from marking the portfolio of trading securities up or down to their fair market value at the end of the year shows up on the income statement as unrealized holding gains and losses, meaning it immediately goes into the current revenue and expenses for the year. In other words, the income statement for the year. But available for sale securities, their unrealized holding gains and losses do not show up on the income statement, but instead show up in other comprehensive income, that final financial statement that we are yet to talk specifically about, but we're going to do it a little bit today. So let's see a little more about trading securities and available for sale securities at year end. So at year end, because we carry trading securities and available for sale securities at their market value, we need to mark them up or down to their market value at the end of the year. And the price changes for trading securities for that year, no matter what is in that portfolio, those unrealized gains and losses appear on the income statement. But if you have price changes when you mark the available for sale securities to their market value at the end of the year, their unrealized price changes shows up in the shareholders' equity section of the balance sheet and does not show up on the income statement at all. It's a part of other comprehensive income. So, and when do we make this decision as to whether it's a trading security or available for sale security? Not till the very last day of the year. So you have full information when you decide whether to classify your short-term investments as trading securities or available for sale securities. So let's take a look at what an other comprehensive income part of the financials looks like. So this is the Coca-Cola Company, and notice that we have the net income amount, and then we have another section called Other Comprehensive Income, which is marking various assets up and down to their fair market value or fair value at the end of the year. By doing this, we're trying to measure wealth, not revenue minus expense or income. So this is trying to show us the impact of the company's actions for the year on their comprehensive view of income, meaning fluctuations in your investments and other instruments, as well as what you did on the income statement. Now, this less comprehensive income attributable to non-controlling interests, that has to do with if you have minority shareholders when you buy another company. So more on that in a little bit. But this is what we call OCI, or Other Comprehensive Income. So here's an example. Here's Merck in 2012. And notice they have the net income, and then they have OCI. So as soon as I see other comprehensive income, I know that any net unrealized gains or losses are from available for sale securities market fluctuations as we mark them to their fair market value on the last day of the year. So the question is what happened to those investments over the various years? Well, in 2010, the portfolio had to be marked down to the fair market value. In 2011, it had to be marked down. And notice that the portfolio can be different stocks. You're not keeping the same stocks all the time because the intent of available for sale and trading securities is a place to park your cash where it can earn a good return. So it doesn't matter what the mix of the investment instruments are. It's just that when you value that portfolio at the end of the year, you either marked it up or you marked it down. And good news, in 2012, you got to mark it up to the fair value at the end of the year. So those show you the differences. Fast forward. Now we're in 2014, and we see the same OCI, and here for short-term investments. So we know that this is available for sale securities again, and we're marking them up or down to their market value on the last day of the year. Well, here's another one. It says Bristol Myers Squibb in 2014 included a $3 million line item called unrealized gain from short-term equity investments. Notice they included this on the income statement. So is that available for sale securities or is that trading securities? And you're right, since it shows up on the income statement, it's when we marked the trading securities to their fair value on the last day of the year. So it says during the year, the company maintained a portfolio of marketable securities in the current asset section, meaning trading securities, of this amount. So what does that represent? That's the fair market value on the last day of year, because we mark up or mark down our trading securities to their fair value on the last day of the year, which is that amount. So under current accounting rules, how will this $3 million gain be reflected in the financial statements? Well, it's already in the income statement, and so it goes into the normal income statement as, in this case, other revenue of $3 million gain. Here's another problem where we're given two categories, trading securities and available for sale securities. They're both current assets. They both are marketable. It's just we've made this call the last day of the year as to which are going to be trading and which are going to be available for sale. And notice the portfolio is made up of these different companies. And they say there's no transactions in short-term equity securities during the year, and these are our values in these portfolios at the end of the year. The first question on the next page is what is the overall changes in the short-term investments? So the change for Wherever Fabrics, if we take the full portfolio of short-term equity investments beginning of the year versus what the Wherever Fabrics were at the end of the year, we can see that Wherever Fabrics increased $12,000, whereas Frames Corp beginning to end increased only $2,000, whereas Pacific Transport began the year at $895, ended the year at $871. So it had a loss, the unrealized holding loss of $24,000, and Video Magic beginning to the end of the year, had an unrealized holding gain of $13,000. Notice we did not actually sell any of these things. These gains and losses happened because we reevaluated our stock portfolio, in other words, trading securities and available for sale securities, to their fair market value at the end of the year. So let's see the questions to the problem. We already answered the first one. So the first one says, what's the total change? Well, we've looked at that. But trading securities, unrealized holding gains and losses, will go to the income statement, whereas available for sale securities, gains and losses, unreal, will go to shareholders' equity in OCI, or other comprehensive income. So as you can see, for wherever the gain went to the income statement, the loss was parked in shareholders' equity, whereas for frames, the unrealized holding loss went to the income statement, whereas the unrealized holding gain from frames went to shareholders' equity. Whereas Pacific, they had losses both in trading securities and available for sale securities. So 20,000 trading securities losses, unrealized holding losses, went to the income statement, and 4,000 of available for sale securities went to shareholders' equity and OCI. Whereas Video Magic had both unrealized holding gains, so 10,000 for trading securities went to the income statement, and 3,000 for available for sale securities went to OCI, or shareholders' equity. So explain why the answers to A and B are not the same. Because trading securities unrealized holding gains and losses goes to the income statement, whereas available for sale securities unrealized holding gains and losses goes to shareholders' equity. Remember that this is all the result from marking our portfolios to their fair value the last day of the year. And when do we decide whether they're going to be trading or available for sale? The last day of the year. So in part D, how would your answer change if you chose the fair market value option instead for AFS? Well, the fair value option says for your available for sale securities, treat them just like you do trading securities, so all the gains and all the losses that are unrealized or holding oriented go on the income statement, and there is no SHE account for unrealized gains and losses. So if that's the case, the answer to D would be the same as the answer to A.